While social media debates whether this cycle is over or whether the next rally has already started, some of the biggest financial institutions in the world are quietly expanding deeper into digital assets. Visa is building stablecoin infrastructure, Bank of America is reorganizing around tokenization, traditional finance is launching new crypto investment products, Ethereum and Solana ETF filings continue to arrive. Meanwhile, XRP is seeing one of the biggest exchange withdrawal trends in years. Nothing in this video is financial advice. Always do your own research before making any investment decisions. Welcome back to Ledger Pulse. Today, we're looking at where the infrastructure is being built, what institutions are preparing for, and why experienced investors often pay closer attention to these developments rather than short-term market noise. Blockchain Backer recently posted something surprisingly simple. 3 things are true in life: death, taxes, crowd groupthink gets wrong-footed at reversals. It's only one sentence, but there's a lot packed into it. Markets don't usually fool the majority by accident. They fool the majority because emotions become strongest near turning points. Near market tops, optimism becomes way overwhelming. Near market bottoms, fear becomes overwhelming. That's why reversals rarely feel comfortable. If everyone agreed the market was about to explode higher, buyers would already be positioned. Likewise, when everyone believes prices are headed much lower, much of the selling has often already happened. This doesn't mean every correction is automatically bullish. It simply reminds us that consensus isn't always correct. Some of the best long-term opportunities have appeared precisely when confidence was disappearing. And you know how the saying goes, history doesn't repeat perfectly, but it often rhymes. While price dominates headlines, infrastructure keeps expanding. Ripple announced support for the newly launched X402 Foundation under the Linux Foundation. For anyone unfamiliar, the goal is fairly straightforward. As AI agents become more common, they'll need a standardized way to send and receive payments automatically. Imagine software paying another piece of software instantly for data, computing power, or online services without requiring humans to manually authorize every transaction. That may sound futuristic, but many companies are already preparing for it. Ripple says XRP and RLUSD are among the assets being supported for these next-generation payment standards. Whether AI payments become mainstream tomorrow or several years from now isn't really the point. The point is that companies aren't waiting. They're building now. Throughout crypto's history, infrastructure has almost always been built long before widespread adoption arrived. Visa announced its new stablecoin platform. Instead of simply processing card payments, Visa wants banks and financial institutions to mint, move, and manage stablecoins through Visa-managed infrastructure. That's a big shift, not because Visa is replacing traditional finance, but because it's preparing for digital finance to operate alongside it. Think about what Visa does today. It connects financial institutions across the globe. Now, it's extending those capabilities into blockchain-based assets. The conversation has evolved dramatically over the past few years. It used to be whether large payment companies would embrace blockchain. Today, the discussion has shifted toward how they're integrating it. Institutional demand continues expanding. Morgan Stanley has reportedly filed for spot Ethereum and Solana ETFs. At nearly the same time, Rowe Price launched its active crypto ETF. Instead of focusing on just Bitcoin, the fund includes exposure across several major digital assets. Whether investors choose ETFs or direct ownership isn't really today's discussion. The takeaway is that traditional investment firms continue creating more ways for capital to enter the digital asset space. Each new product lowers another barrier for investors who may have been hesitant to navigate exchanges, wallets, or self-custody. Access keeps improving. Participation keeps broadening. And historically, easier access has often translated into larger pools of potential capital over time. One of the more interesting on-chain developments involves Binance. According to CryptoQuant contributor Amir Ta, XRP withdrawals have climbed to their highest levels in at least 2 years. Binance's share of withdrawal transactions has increased substantially while deposits have fallen. Why does that matter? When investors withdraw assets from an exchange, those coins are often moving into personal wallets or long-term storage. It doesn't automatically mean selling pressure disappears. Coins can always be sent back later. But historically, sustained exchange outflows have often reflected investors choosing to hold rather than keeping assets immediately available for trading. It's only one metric. No single indicator predicts price by itself. Still, it's another data point suggesting that at least part of the market may be positioning differently than it was only a few months ago. Another headline that deserves attention came from Bank of America. The bank has appointed new executives to oversee digital asset platforms, tokenization, stablecoins, and AI transformation. Notice something interesting. These aren't isolated blockchain experiments anymore. These are organizational changes. Large financial institutions don't typically restructure entire business divisions around technologies they believe will disappear next year. Instead, they build teams. They hire leadership, they allocate budgets, they prepare for future demand. That's what we're seeing across much of the financial industry. Not just one bank, not just one payment company, but an increasing number of major institutions. Regulation may finally be getting closer. Market structure legislation remains one of the biggest topics facing the US crypto industry. Recent comments suggest movement could happen sooner rather than later, although several procedural hurdles remain. Nothing is guaranteed until legislation actually passes. Congress can change timelines quickly. Votes can be delayed, language can be revised. But compared to where things stood just a few years ago, the conversation has clearly advanced. Instead of debating whether crypto deserves a regulatory framework, lawmakers are increasingly debating what that framework should actually look like. That's meaningful progress. Clear rules don't guarantee higher prices, but they can reduce uncertainty for businesses deciding whether to build inside the United States. Major trends are usually built from dozens, sometimes hundreds of small developments that gradually reinforce one another. Eventually, people look back and say, it was obvious. In reality, it usually wasn't obvious at all. It only appears that way after the pieces have already come together. That's why paying attention to infrastructure can sometimes be just as valuable as watching price. Prices fluctuate every day. Infrastructure tends to last much longer. Those are the stories I'm watching most closely right now. The market may continue to experience volatility and no one knows exactly what happens next, but it's becoming increasingly clear that while short-term sentiment swings between fear and excitement, many of the world's largest financial institutions continue expanding their involvement with digital assets. Now I'd like to hear from you. Which development do you think matters the most over the next few years? Is it Visa's stablecoin platform, the continued wave of ETF products, Bank of America's tokenization push, or Ripple's infrastructure work? Let me know down in the comments. If you enjoyed this breakdown, don't forget to like the video, subscribe, and turn on notifications so you never miss an update. Thanks for listening, and I'll catch you in the next one.